All right, so let's talk about, we've talked about the income statement and balance sheet. Let's talk about the third financial statement, the cash flow. Not surprisingly from its name, really measuring cash generated or used during a particular period of time, whether 12 months or a 3-month period or what have you, and really a bridge between the income statement and the balance sheet. All right, based on accrual accounting, you'll have some timing differences in cash. The cash flow statement will reconcile that and is usually set up in 3 different sections. The first section we'll see is cash from operations. All right, so our cash from operations section starts off with net income. So the last line item on our income statement, net income. And to that, we're going to add depreciation and amortization, and then any other non-cash charges. All right, remember, source for depreciation and amortization always from the cash flow. This is where you're going to take it. Sometimes that's where you're going to source it. Sometimes that's broken out separately. That is depreciation expense, amortization expense, but you want to get both of these from the cash flow statement. Okay, you might see other non-cash charges during the year. You might see plus or minus any non-recurring gains or losses, non-cash gains or losses on sales of assets or what have you. All right. You'll typically then see plus or minus something called changes in working capital accounts. Changes in receivables, changes in inventory, etc. during the year. All right. Anybody ever hear the term that a company can grow broke? Basically what we're talking about there is usually, we're usually speaking from a working capital perspective. Companies that are growing, particularly asset-intensive companies that have a lot of inventory or maybe a lot of accounts receivable, as they grow, that can tie up a lot of their cash. So the company might be generating a lot of sales, a lot of growth in its revenues, but because they have so much cash tied up in their working capital, they end up going broke. They end up being cash flow insufficient. All right, so changes in working capital accounts are measured here, things like accounts receivable and inventory. All right, to the extent those items are growing during the year, is that a source or a use of cash?
Is that why companies will leverage their accounts receivable?
That's why they'll borrow against their accounts receivable and inventory to get that cash out now. All right. But to the extent that receivables, inventory have increased during the year, would that be a source or a use of cash? It's a use of cash, right? If a company's buying inventory, for example, they're probably having to write a check. They're probably going to have to fund that somehow. A lot of times that can be a use of cash. Conversely, if they've got accounts payable, they can borrow from their vendors. So in other words, instead of buying inventory with cash, I can tell them, I'll pay you later. That would be a quote-unquote source of cash, would appear as a positive on our cash flow statement. All right. Whole cash flow statement is listed in terms of positives and negatives. Positive numbers are sources of cash, negative numbers are uses. All right. We'll go into a lot more detail on changes in working capital, but I just wanted to introduce the difference or the concept of sources and uses of cash in the working capital context. All right, so that'll be, we'd add all those items up, would give us cash from operations. Next section would be cash from investing activities. All right, what's a common investing activity that you'd see? Things like capital expenditures, additions to a company's plant, property, and equipment. So going out and buying more buildings, going out and buying more delivery trucks, going out and buying more computers, furniture, fixtures, etc. All right, so additions to the company's fixed infrastructure, referred to as CapEx. And I list it in brackets because it would be a use of cash. Companies buying stuff, they're writing a check for it typically. Or maybe they're financing it another way, but that increase to plant, property, and equipment is listed as a use of cash. Purchase or sale of maybe securities. That type of thing might fall under cash from investing. Companies acquiring other businesses, acquisitions would be listed there as well. All right, we add all those together, would be our cash from investing. And then our last section on the cash flow is cash from financing. Basically changes in our debt and our equity accounts. The company's borrowing, that's cash coming into the organization. All right, a lender is extending credit, they're giving us cash. So that'd be a source. If we're repaying debt, obviously that's a use. Okay, so plus or minus, basically changes in debt, plus or minus changes in equity accounts. All right, so if we're selling more stock and getting cash in, that's a source. If we're buying back stock, treasury stock, that'd be a use. Okay, if we pay dividends, that would be a use of cash, etc. We'd add all those up, that would be our cash from financing. And our total change in cash for the year is going to be cash from operations plus cash from investing plus cash from financing equals total change in cash or total cash flow for the year. Make sense? So we basically just looked at all the possible inflows and outflows of cash. And if we add this total change in cash to our beginning cash, the beginning of the year, that gives us what? Gives us ending cash. All right. Which goes back up onto our balance sheet. It's that first line on our balance sheet. But basically, as we said, the cash flow statement reconciles the income statement and the balance sheet accounts to tell us from a cash flow perspective what has changed. And for us, the important items, all of these are important, but the most immediately relevant item is that D&A, source of depreciation and amortization, and we get it off the cash flow statement. So when you do your homework tonight, we're asking for EBITDA, you're going to get it from here. And again, cash flow statement, source of depreciation and amortization, gives us an idea of what's going on in the company's working capital accounts, its current assets, its current liabilities, and tells us overall how's the company generating, how's it spending its cash. All right, so a lot of times we'll look for trends in operating cash flow. That is the company generating more and more cash from its operations every year? Or maybe are its operations slipping a bit? All right, maybe its cost structure is going up. That would flow down and affect net income. Okay, maybe it's not collecting cash as quickly as it did from its customers. That would affect cash flow. All right, so those trends in cash flow, operating cash flow, trends in CapEx. Is the company spending enough to replenish its fixed infrastructure? You kind of think of fixed infrastructure almost a little bit like a car. Right? If you own a car and you never change the oil, never change the tires, never do those maintenance items to keep it running well, eventually you're going to be hit with a big repair bill at some point. Same thing goes for a company. If they're not maintaining their equipment, eventually the equipment's going to break down and cause them trouble in the long run, right? Okay, are they acquisitive? Are they paying with cash for acquisitions? And how are they doing with their debt accounts? Are they paying down their principal and their debt? Or are they borrowing more and more and more every year? All right, you might see cash on the balance sheet going up and up, but if operating cash flow is deteriorating and they're funding that deterioration through borrowing, eventually that can't continue. All right, if a company continues to get worse operationally, eventually the lenders are going to say no more, right? So those types of things you can assess by looking at a cash flow statement as well. Any other questions? All right, let's talk about normalizing the financials, and specifically what we're going to be talking about here is addressing those non-recurring charges that I talked about before. Okay? It is really not that difficult to go through a financial statement, take numbers off the hard copy pages, and put them into Excel. It doesn't take a whole lot of skill to do that. Where the analyst in an investment bank or private equity fund adds value, truly adds value to the process, is figuring out from a sustainable go-forward basis, what can this company look like in the future? Where are those non-recurring items? Why have they occurred? How can we strip those out and normalize the company's financials to account for those things? All right, so this is where really an analyst starts to add true value in the process. And when we talk about non-recurring items, we're talking about things like maybe abnormal legal costs. Maybe the company got hit with a one-time judgment against them. They had to pay $1 billion settlement, but it settles the suit. They wouldn't have those expenses in the future. It works the other way too. Maybe the company got a huge inflow of cash because they won a lawsuit. Well, they're not in the business of winning lawsuits every year. They're in the business of maybe selling shoes or selling ketchup. So that those abnormal legal costs or inflows of cash we would want to normalize for those. All right, severance charges. A lot of companies taking severance charges this time or this stage of the economy. So mass headcount reductions, we wouldn't expect the company to cut half their headcount every single year. A lot of times those would be non-recurring charges. Factory shutdown costs, same thing. All right, to the extent that it's truly a non-recurring cost. Natural disasters, hurricanes, et cetera, man-made disasters. Sometimes you'll see asset impairment costs. A lot of times when you see an impairment cost, in many cases it relates to goodwill on the company's balance sheet. What's goodwill? When a company gets sold, goodwill is, let's say it gets sold to another company, goodwill is what gets created in that process to reflect the difference between the market value of that company's equity in the sale and the book value on its balance sheet. All right. Goodwill is a non-tangible, it's an intangible asset that would get booked on the acquirer's balance sheet. Goodwill can no longer be amortized. It used to be that we could amortize it, take a non-cash charge every year, reduce our taxes a little bit. We no longer can do that. What happens with goodwill is it gets tested every year by the accountants for impairment. All right, and to the extent that the company overpaid for that business it bought 2 years ago, maybe the value has declined, then the company would be forced to write down its goodwill, take an asset impairment charge, all right, and to the extent that that's a non-recurring item, we would add that back. All right, any profits, losses from sale of equipment, again, if it's not in the company's regular business isn't to sell its delivery fleet, or to sell all of its old equipment, or maybe sell a piece of real estate, that might be considered a non-recurring source of cash, or maybe a non-recurring loss if they have to sell it at a loss. All right, so we'd want to adjust for that. And then any integration costs associated with mergers. Okay. Does everybody, I'm going to talk about how we adjust for them in a moment, but does everybody understand why these types of items would be non-recurring and why we would want to adjust for them? Does that make sense so far? Okay. When we find these items, and again, we'll usually find these in the MD&A section. So to the extent that the company got hit with Hurricane Ike-related charges of $1 billion last year, and they took $1 billion charge on their income statement, it would probably be discussed in the MD&A section. It would be called out as a non-recurring or an unusual item, and that would be our first indication that we need to make an adjustment to normalize the financials for it. All right, so that's usually where you'll find it. And when we do find them, we have to make sure we understand when did it occur, and real importantly, in the income statement, where were they accounting for it? In other words, did that item occur, or did it appear in the SG&A number? That's typically where you'll see those items. It'll be in the operating expenses of a company. You'll see included in SG&A was a $1 billion non-recurring charge associated with damages we sustained from Hurricane Ike. All right, in 2008. So in that case, we've answered the question, when did it occur? Where was it in the income statement? It was in SG&A, so it was above EBIT, which means everything from EBIT and below is affected. And is it an abnormal expense or income item? Okay, and we decided that was an expense. Okay. So it's not always clear. Sometimes when you look at an MD&A section, they might talk about this year. Sometimes they might also talk about last year's results relative to the prior year. So you need to always make sure you understand when it occurred and account for it accordingly. All right. Whether it occurs above or below the EBIT line, again, that's important because if it occurs above the EBIT line, it means that EBIT was affected and everything below EBIT was affected as well. Sometimes you might see non-recurring charges, though, or non-recurring income that appeared below the EBIT line. All right? In that case, it would not have affected EBIT. It would have affected only those things that fell after it. And most valuation templates, when you're spreading financials, will give you the option. Did it occur above or below? And you need to make sure that you adjust accordingly. All right, and then finally, is it an expense or an income item? If it's an expense, and let's say it's an expense that was in SG&A, it affected EBIT. So in the case of my Ike example, what would that mean for EBIT in the financials? Would it have been over or understated by $1 billion? It would have been understated, right? If there was $1 billion charge, that means EBIT was unusually low by $1 billion. From our standpoint, we would add it back. And by adding it back, we would have quote unquote normalized to eliminate that item, basically to present those financials as though that item never occurred. Because again, we don't expect $1 billion of hurricane damage every single year. We view it as a one-time expense. And the opposite holds true for a gain. Say we win a lawsuit, we win $1 billion. We get $1 billion cash flowing in, we've got a $1 billion income item that's in our SG&A. That means EBIT and everything below, they were inflated by $1 billion. We'd want to back it out because we don't expect to win $1 billion lawsuits every year. Or have maybe $1 billion charges every year, maybe unless we're the tobacco industry or something like that. All right. Do these items make sense conceptually? Abnormal expense items get added back, abnormal gains get deducted. All right. And then obviously taxes are always impacted by anything we do. Okay, and the valuation template that we have will automatically calculate what taxes would have been absent that event. Right, you need to make sure you do that. So in other words, if EBIT should have been higher by $1 billion, the company would have had an additional $1 billion of taxable income. We would want to adjust the taxes as though it did in fact have an additional $1 billion of income. Make sense? We'll show you how to do this in the valuation template tomorrow, but it's pretty straightforward. Okay, let's talk about financial ratios, and then what we'll do is introduce the homework, kind of outline some of the key concepts that you'll see whenever you work within Excel and investment banking. All right. So when we talk about financial ratios, these are ratios and figures that oftentimes need to get calculated when we're analyzing a company's strength or its liquidity or something like that. All right. And there are several different types of financial ratios. The ones we're going to talk about are liquidity, that is, how liquid is the company, how much cash or its ability to generate cash quickly if it needed it. Right. How much leverage does the company use? That is, how much is its debt relative to maybe its equity or relative to its EBITDA? All right. It tells us what does the company's capital structure look like. Activity ratios, how quickly is the company turning over its assets or paying down